Hello everyone, welcome to EduTap. So in today's session, we are going to discuss a very important finance news article that is regarding the new rules, the new norms for the digital lending that has been released by the Reserve Bank of India. So the Reserve Bank of India has accepted the recommendations of the working group on the digital lending, and after accepting the recommendations, the RBI has released the digital lending norms. Okay, so what is this regulatory framework that is released by the RBI for the digital lending? What were the recommendations that have got accepted by the Reserve Bank of India? And what was the need for the tightening of the rules for the digital lending or bringing a regulatory framework for the digital lending activities? So all of this we are going to discuss in today's session. But before starting with the session, please subscribe to our YouTube channel if you are new to the channel and join our Telegram channel for the PDF of the session. And you can get the link of the Telegram channel in the description box below. So now, starting with the RBI has issued the first set of much awaited regulatory framework for the digital lending. So the digital ecosystem, the digital system of the country, that is what the RBI is promoting. The RBI is doing a lot of work to promote the digital system into the country, to promote the digital ecosystem into the country. Okay. So recently, the innovative methods of designing and delivery of credit products, okay, and their servicing through digital lending route have acquired prominence. So it is happening that the credit that is being available through the digital platforms, through the digital apps, that is gaining transaction, that is gaining importance. Okay, why? Because they are fast. We can get them without going to the physical infrastructures of the banks. Okay, without going anywhere, just sitting at our homes, we can get the credit easily available to us. Okay, so that's why the digital lending route is gaining the prominence. It's gaining the importance in the lives of the people. So the credit products are being taken through the digital platforms. But what is the problem? That the RBI has to release and RBI has to tighten the norms for the digital lending. What was the problem that was faced? Okay, so what was happening, that there were certain concerns that have emerged which, if not mitigated, may erode the confidence of the members of the public in the digital lending ecosystem, and the public may go away from the digital lending ecosystem, because once our trust is lost, we will not, it will take time to build the trust again. So that's why the RBI warns that such kind of things that is happening through the digital lending ecosystem, that is eroding, that is degrading the trust of the people, that is not standing up to the trust of the people, that systems, that type of function should be stopped. So what are these functions that are harming the customer protection, that is harming the customer confidence? Such concerns are related to the uncontrolled engagement of the third parties, the mis-selling or misinformation that is being provided to the customers, like the percentages, the interest rate is given higher when the digital lending route is taken, or the interest rate is changed without telling the customers even. Okay, such kind of things are also happening through the digital lending route. Like the breach of data privacy is also happening, the unfair business conduct is there, the charging of exorbitant, too high of the interest rate, as well as the changing of the interest rate without telling the customer. Even those kind of activities were happening, and so the RBI thought, and the RBI said that there is the tightening of the norms that is needed for the digital lending. Okay, so unethical recovery practices was also there through the digital lending platforms. Okay, if the person is not able to pay back the money, the information regarding the person was used to threaten the family, to threaten the relatives and all. So there was this screen test that happened, and this is from the LiveMate. And it shows that RBI has issued the rules for the digital lending following complaints that the RBI was receiving regarding the usurious rate, regarding the too high of the interest rate, pursuing aggressive recovery practices that was happening. Okay, too aggressive recovery practices was done to take the money back from the borrowers. Okay, and committing fraud. There was fraud also that was happening, like whenever the digital lending or the digital platform wants, they were increasing the interest rate without telling the customer. Okay, So it shows that in financial year 18, the private sector banks, they were providing this much of the digital lending and it decreased. But if we see from the NBFCs have increased the digital lending activities. Okay, they are lending through the digital platform. So in 2018, you can see it was only this much, but by 2020 financial year 2020, 2019-2020, it increased to this much. Okay. So this is what it shows, that the NBFCs have increased providing the loans through the digital lending platforms. So, and you have seen the concerns. So what RBI has said, what RBI has done, the RBI has just brought the digital lending rules, or the RBI was working on it for a long period of time, that we will see now. Okay, so the recommendations of the working group on digital lending. So the RBI has constructed a working group on the digital lending, including the lending that was happening through the online platforms and the mobile apps. So this kind of working group was formed in January 2021, and it was under the chairmanship of the Shri Jayant Kumar Das. Okay, so this he was the chairman of the working group, and this working group was formed so that the digital lending that was happening at that time, and there was the problems, the concerns, the customer protection that was harmed. So all of this that was happening, to work on that, to give the recommendations regarding that, to give the suggestions regarding that what RBI can do. So regarding that, the working group was formed and the report was submitted by the working group on the digital lending. Okay, after that, in November 2021, I guess the report was submitted, and after that the report was kept on the website of the RBI, so that the stakeholders, the public stakeholders, the people that were engaged, they can give the comments that okay, this recommendation is really good, this recommendation can be improved, this suggestion can be improved. So regarding that, the report was kept on the website. Okay, after that, now in this month only, on August 2022 only, the RBI has released the framework, regulatory framework, that we are going to see. So the regulatory framework is to support the orderly growth of the credit delivery. It's not like we want to stop, or RBI want to stop the digital lending activities, because the RBI wants to go towards the digital ecosystem. So the RBI wants the growth of the credit delivery through the digital lending methods, while mitigating, while reducing the regulatory concerns, while reducing the harm that is happening to the customer protection, that is happening to the trust of the people. Okay, has been formed up. So the regulatory framework is to promote the digital lending while mitigating the risk that is involved with the digital lending. Okay, the regulatory framework is based on the principle that lending business can be carried out only by entities that are regulated under the Reserve Bank of India, or that are regulated under some law. Okay, so only those that are regulated by the law or that are regulated by the Reserve Bank, they should be providing the digital lending. Okay, so that we can track that okay, this is happening, or the complaints are coming, or this organization is creating the problem, so that can be tracked because they are regulated. If one entity is not regulated by any controlling body, any of the authority, then that body, that entity that is doing the frauds, the RBI will not be able to catch it. Okay, so now the digital lenders. Who are the digital lenders? So they are classified in three groups. First, digital lenders are those entities that are regulated by the RBI directly, and they are permitted to carry out lending business. Okay, they can be the NBFCs, because there are many NBFCs that are directly regulated by the Reserve Bank of India, or there can be the banks that are permitted by the Reserve Bank of India to lend. So these are the entities that are regulated by the Reserve Bank of India. Then there are some NBFCs, some entities that are not regulated by the Reserve Bank of India, but those are regulated by some other statutory or regulatory provisions. Okay, but not regulated by RBI. So they can be regulated by the SEBI, they can be regulated by the EDI or the NHA, and means the other regulatory bodies are controlling the other entities. So the second category is that. Then there comes the third category, that is not regulated, that is not under the purview of any of the statutory or regulatory provisions. Okay, so these are the third kind of entities that create the most of the problems. Okay, so the first category is the Reserve Bank's regulatory framework is focused on the first category because they come directly under the RBI and the RBI can look after them. Okay, because the RBI knows that okay, this organization is working like that, and this organization, the entities that are under the Reserve Bank of India, they provide the data to the Reserve Bank of India, okay, that work under the Reserve Bank of India. So the regulatory framework of the Reserve Bank that is created for the digital lending, that is focused on the digital lending ecosystem. This will regulate the RBI's regulated entities and the lending service providers that are engaged by the regulated entities to extend the various permissible credit facilitation services. So the regulatory framework that we are going to see now, that is for the regulated entities that are under the Reserve Bank of India or the lending service providers that are engaged with the regulated entities that are under the Reserve Bank of India. Then comes the second category, that is as regards with the entities that is falling under the second category, the respective regulator, the EDI is there, the SEBI is there, they have to control or they have to formulate or enact the appropriate rules so that the entities of the second category, they can also work for the benefit of the people that do not harm the consumer protection. Okay, so regulations have to be formed as per based on the recommendation of the working group of the digital lending that was formed in January 2021. For the entities in the third category, the government is the one that has to take the step and that has to make the laws, because the third category, this does not come under any of the regulator, this does not come under any of the controlling authority. So the central government is the one that has to make the laws for such categories, such entities. Okay. Now coming to the recommendations that has been provided by the working group and that has been accepted. Okay. So certain highlights we are going to see because the recommendations were quite many. So we will see the highlights of the requirements being mandated to be followed by the regulated entities. Their lending service providers, that is the regulated entities have the lending service providers, okay, that are, we can say, agents that connect the regulated entities with the borrowers. Okay, so lending service providers are a kind of agents that connect the regulated entities with the borrowers. Digital lending apps are there, that can be the app of the lending service provider or that can be the app of the regulated entity like the SDFC, like the ICICI Bank, like many of the NBFCs, they have their own digital lending app or they can use the agents app to provide the digital lending. Okay. Then comes the DLAs of the LSPs, that is the digital lending apps of the LSPs are also there, engaged by the regulated entities. So we will see the highlights now. Okay, so first of all we are going to start with the customer protection and conduct issues. So these are the recommendations that have been accepted by the Reserve Bank of India, and this is regarding the customer protection and conduct issues that the working group has provided these recommendations to protect the customer and to have the better conduct, better business conduct for the digital lending platforms. Okay. First of all the loans that are provided, okay, the loans that have been given, the repayment should be directly from the regulated entities by the borrowers to the regulated entities. So the money should go from the banks or the regulated entities to the borrowers, and the money should come back, the repayment should come back from the borrowers to the regulated entities. The third party should not be involved in the transaction of the money, okay, in the transfer of the money. So all the loan disbursals and the repayments are required to be executed only between the bank accounts of the borrower and the regulated entities. Like if it is a bank, the bank is giving the loan, so loan should directly go to the bank account of the customer, of the borrowers, and the repayment should directly come from the borrower to the regulated entity, that is some bank or some NBFC. The third party should not be involved in this, okay, in the repayment or the dispersal of the loan, because the third party might take out some of the part of the money and the banks will not be able to know. Customer might think that okay, this much loan I would have got. So the third party can create some trouble, and that's why there should be no third party in the exchange of the money at least. Okay, any fee or the charges that is payable to the lending service providers, that is to the agents, the money should be provided by the regulated entities, because the regulated entities are the ones that are hiring this service providers. So the regulated entity should pay the charges, should pay the fees or something. Okay, so it should be directly given from the regulated entity to the LSPs and not by the borrower. A standardized key fact statement has to be formed in which everything will be written that okay, this much charges are there, this much fees is there, this much interest rate is there, this much loan you will get, this much loan you have to pay back. So all the information have to be provided under the key fact statement, and this will be provided to the borrower before executing the loan. So before providing the loan, you have to provide all the information, because what the third parties were doing, what the digital lending platforms were doing, they were not providing the complete information, or they were giving the misinformation that you will get the loan on 6%, but they were not telling that after 1 year your percentage will go to 9%, after 2 years your percentage will go to 15%. So such kind of information they were not providing. Okay, so the key fact statement provides all the information that is there regarding the loan taking. Okay, that has to be given to the borrower before executing the loan contract. Then there comes the inclusive cost of digital loans. This has to be told in the KFS, so also key fact statement. So everything, all the information has to be provided under the key fact statement. Then comes the automatic increase in credit limit. This should not be done. Okay. So what happens that automatically the credit limit can be raised of the person, and the person do not even know. The person thinks that okay, in my card I only have 3 lakhs that I can take out, but automatically the limit has been raised by the third party, okay, or by the platform or digital lending platform or some regulated entities also, and the limit has been made to 6 lakh. And the person unknowingly might use this much amount and may not even know. So that should not happen. The automatic increase of the credit limit should not happen without the explicit consent of the borrowers. There should be a cooling off or lock-up period in which the person can repay the loan. Even if the loan is of 2 years, but the person think that okay, I can repay this much amount in 6 months. I can repay all of my loan in 6 months. So that should be allowed without any penalty. Okay. So there should be a nodal grievance redressal officer that should be present, so that the complaints that is coming against the regulated entity, that is coming against the digital platform, digital app, or that is coming against the lending service provider. So there should be a nodal grievance redressal officer that takes care of the complaints. Okay, so the regulatory entities shall ensure that they and the LSPs that is engaged by them shall have a suitable nodal grievance redressal officer to deal with the fintech or the digital lending related complaints. So any complaint that is coming in the digital lending platform, or that is coming regarding the finance technology that the banks are using or the regulated entities are using, so there should be a nodal grievance redressal officer. Then, as per the existing RBI guidelines, if any complaint that is lodged by the borrower is not redressed, okay, the answer is not coming back to the customer that your complaint is taken, or we are doing some work on your complaint. If no answer is coming to the borrower, or no step is taken by the regulated entities to resolve the problem of the customer, then the customer after 30 days, currently 30 days that is there, after 30 days the customer can lodge a complaint with the Reserve Bank Integrated Ombudsman Scheme. So the complaint will directly go to the Reserve Bank Integrated Ombudsman Scheme. First, the complaint will go to the nodal grievance redressal officer that is hired by the regulated entity or the LSP. But if they are not doing anything, if the regulated entity is not doing anything, then the complaint will go after 30 days to the Reserve Bank Integrated Ombudsman Scheme. Okay, under this. Okay, coming to the technology and data requirements. So the data that is collected by the digital lending apps, that should be need based. Only that much data should be taken that is actually needed to process the credit, because of course if you are giving the credit, you need the income statement of the person, that how much the person is earning, the collateral that the person can keep, but no more information than the need should be taken from the customer, and the prior explicit consent has to be taken from the borrower that okay, we are taking this much of your information. And if the customer wants, the data has to be deleted, or there is option to revoke the previously granted consent or even the delete the data that is collected from the borrowers. Okay, so that is how the consumers will be protected against the data breach, how the consumers can be protected from giving the excess data or taking the excess data. Okay, without the information of the customers, the data is used by the people, by the regulated entities or by the middlemen, okay, by the third parties. So that will not happen now because there are the new rules that are there. The regulatory framework, any lending that is sourced from the digital lending apps is required to be reported to the credit information companies so that the data can be kept with the credit information companies, because they are the ones that get all the data regarding the credit that is going into the system, into the economy. So the credit information company should have the information of even the credit that is being given through the digital lending apps. Okay, so all the information regarding the credit, even if the credit is from the digital lending apps, that should also go to the credit information companies, irrespective of its nature. Even if you are giving the loan for 15 days, then also the data has to be given to the credit information companies. Okay, so if the regulated entity is giving the credit through the DLAs, through the digital lending apps, then also the information has to be given to the credit information companies. All new digital lending products, that is all new digital lending that is happening, all new credits that has been given by the regulated entities over the merchant platforms, over the apps or something, involving the short-term credit or deferred payments, like the payments for the mobile I have bought. So that is the credit that I am taking. I am taking the credit that, okay, I will pay this amount for the money, 20,000 for the money, in 4 months, in 4 installments. Okay, so that deferred payments or the future payments, that should also be provided, the information regarding that should also be provided to the credit information companies. Okay, because this is also a kind of credit, because I am saying that I will pay later. Okay, and the mobile is of 20,000 but I will pay 22,000. So this 2,000 is actually the interest that I am paying for delaying my payments or paying later. So all the information has to be provided to the credit information companies, the smaller or the bigger, all the information regarding the credit, even if it is from the digital lending platforms, and every information will go to the credit information companies. So I hope you have understood the news article really well. This is the question that you have to answer. I hope you will be easily able to answer this question. As well as this is the second question that you have to answer, that as per the recently released regulatory framework for the digital lending, you have to tell that which of the following will have to keep all the information. Okay. So thank you very much. If you have any query, you can mail us here or you can contact us through this number. Thank you very much.